Welcome to CoMotion Labs Fundamentals for Startups. My name is Yuli Rivera, CoMotion Labs Life Sciences Senior Manager, and I will be your host today. Fundamentals for Startups is a regular lecture series open to anyone interested in learning about entrepreneurship or building a startup. Each week, we feature experts from various fields who bring you insights and inspiration and give you the opportunity to ask questions. All sessions are recorded and archived on CoMotion's website. For our full schedule and to register for future fundamentals, please visit the events page of the CoMotion site. CoMotion Labs is a multi-industry incubator program hosting early-stage startups from both inside and outside the UW community. We're committed to nurturing and enabling startups' success through critical infrastructure, training, mentoring, and networking. And we do this without taking equity or IP. We operate out of 3 locations on campus, each with its own industry focus: the life sciences and hardware incubators, which are both in Fluke Hall, and our technology incubator, which is based in Startup Hall. If you're a founder looking for somewhere to thrive, we'd love to talk to you. Before I introduce today's speaker, I want to mention that for next week's event, Jens Molbach, founder of New Impact, will present Building Stronger Business Models through Tri-Sector Innovation. Today, we have Karen Kidder here to present Early Stage Investing 101. Karen is an angel investor, partner at First Row Partners, an early stage VC firm in the Pacific Northwest, and a venture partner at Purpose Built, a venture studio based on the East Coast. In addition, she also invests with E8, an international Seattle-based angel group focused on emerging clean tech enterprises. We'll take questions in the chat, or if you're in our watch party in Startup Hall, feel free to pass on your questions to Caroline. I will now turn over the event to Karen.
Great. Thanks so much, Yuli. And hello, everyone. Thank you so much for having me today. I'm sorry that I'm not there in person, but I'm with the online audience and the in-person audience via this wonderful screen in front of you, no doubt. What I'm excited to talk to you all about today is early stage investing, and I hope it will be helpful for both investors and entrepreneurs. I'm going to skew towards the entrepreneurs and founders side because I believe most of you in the room and potentially online are founders, but I think it's helpful for even founders and investors to have that same kind of information as we go forward. So the first thing I'll just throw out there, which I have to do, it's an obligatory disclaimer that what we're going to discuss is not advice, it's information purposes only. I'm not a professional financial advisor or accountant or attorney, and this is just hopefully things that will help you that are from my experience and viewpoint. So I have to get that out of the way. That's one of my least favorite parts about the presentation, but you have to do it. So Yuli gave a great intro to some of my investment work, but otherwise my background is in marketing and communications across a variety of sectors. More recently, I've worked in the climate tech space, and I worked with that company from a point before the pre-commercialization through their commercialization. So I have some insight from the founder perspective as well. I've also got my MBA from London Business School, and I focused on entrepreneurship and marketing. And I actually stayed on and worked at London Business School and ran a number of entrepreneurship programs. So I've got a little bit of that as well. So between that and then this kind of broad spectrum of investing experience in the early stage space, hopefully some of these insights will be interesting to you all. And as Yuli mentioned, I've done a lot of work across angels and VCs and angel groups, and I've run syndicates, and we'll talk a lot about that through this presentation. So hopefully you will walk away today with some key understandings, maybe some things you already know and we've just expanded upon them, but really the what's, the who's, the how's, and a little bit of the overview of early stage investing. And I think we'll start with just purely a definition of what I mean when I say early stage investing. And I think most people have probably seen this startup financing cycle chart at some point in some presentation if you've worked in this space, but it's useful just to kind of frame our minds around what we're talking about today. So when I'm talking about early stage, I'm talking about when a company is potentially pre-revenue, pre-product, or maybe they have a minimum viable product, maybe some early traction, It's the stage where you haven't really created a ton of value yet, and you're looking for capital to help accelerate you on your path. And there's different types of capital that come along in each of these phases, as both of these charts kind of show. But for the early stage, we're really talking about angels, which we will define in a little bit, your friends and family, early stage VCs, accelerators, which UW is very familiar with. And I should further clarify that, I'm talking about in this presentation, more specifically, businesses that are venture scale businesses. So those that really are want to increase their valuation and capture opportunities that are like billions and trillions of addressable markets. So there are a lot of different types of businesses you can launch, but for this purposes of this, we're really talking about venture scale businesses. So the early stage, as you all know, I'm sure, is inherently risky for both the founder, entrepreneur, and the investor. And then, of course, I probably don't need to say this, and it's a horrible statistic, but 90% of startups do fail. They don't necessarily fail in the first year, maybe within 5 years, but it's, I think, helpful to think about some of the reasons why startups fail so that you can be more critical of these areas when you're kind of building a company or when you're investing in a company. And the number one reason they have listed here, this is from CV Insights, is that they ran out of cash or they failed to raise new capital. But I believe that that's kind of correlated with a lot of the items below that. So I'll focus on those and we'll kind of skip over that number one. And I would say that for me, as an investor, the first question that I always ask when I'm talking to a founder is, has this idea really been validated by the market or the customer? And is there really this product market fit? I mean, it's critical to understand your customer and the need in the market. So I would validate that says no market need is one of the reasons that you fail. The next question is usually, why is it unique and what's more compelling about that uniqueness? And that gets into kind of the competitive market, really trying to drill down on what sets you apart and is it enough? And then the next area that I'll just highlight here that I think is important to think about is the business model. If you have an amazing product that people want and it's super unique, and you're not going to succeed though if you haven't worked out how to get it into the hands of your customers and profitably. So again, the key understanding here is just to think about the reasons that startups fail and try and be informed about what makes it so risky so that you can hopefully succeed as either an investor or a founder. So with all that risk, why do people want to even do this? I mean, from either side, not necessarily just investing, but typically when you're talking to investors, one of the reasons that they highlight first and foremost, as you might imagine, is that high risk can mean a high return. Although early stage companies are high risk, if they're successful, they can yield a very high return. And as you can see from multiple sources that I've put onto this screen, if you go about it right, as an investor, you can get returns of 20 to 25%. And as a founder, again, you could be very successful. I'll talk a little bit later about some of the things that increase the probability of receiving those returns. But a couple considerations to keep in mind here too is that they list here that the hold time, which they say is 4.5 years, means the amount of time you kind of have to keep your money tied up into this startup. And I think that's actually a low number. I think it's actually more like 5 to 7 years on average. But so just keeping in mind that if you're investing in this space or working in as a founder, you're in this for a long period of time, right? And then also to think about it from an investment perspective, that this is really an illiquid investment. It's not one that you're going to be selling or turning in at any point until you kind of reach an exit point. So just a couple things to keep in mind when you're thinking about that. I would say that although investors are going in with hopes of a really good return, there's really a lot more about it than just that. And you have an opportunity to work in an environment that is incredibly stimulating, on either side, and you're constantly learning new things. You're on the forefront of new technologies. You meet amazing people along the way, and you get to put your dollars to work where you want them to be working. So there's a lot of wonderful things that come along with this outside of just the risk return. You know, I got into investing because when I graduated from my MBA a number of years ago, I loved that environment because I was constantly learning new things, and I was constantly stretching my, learning is about different industries or business models. And this is, investing to me is kind of an extension of that. So I've kind of figured out how to do that, but hopefully earning money along the way somewhere in there as opposed to spending it. So now that we've kind of gone through the what, why, I'd love to talk about the who. And in this presentation, I'm specifically going to be talking about angels and VCs, venture capitalists. And I won't focus too much on friends and family or accelerators or crowdfunding, but those are definitely worthwhile to consider as you're looking to raise money or to as an investor. So just to kind of kick it off, what in the world is an angel investor? I mean, probably many of you have heard the term, and it's kind of this mythical thing. It's really just an individual that is investing their own money. They tend to be, high net worth individual. And the one thing that I think is important to understand is that the SEC doesn't regulate these types of offerings, investing in early stage companies. So that means they don't require them to disclose certain information as they might with a public company. And so they deem them to be more risky. And they want to make sure that an angel investor can weather the loss of their investment. So they require that investors are accredited. And when they say accredited, they have these kind of 3 bullets that I have here on this slide that talk about what being accredited means. And it's $1 million in assets or more, excluding your residence, $200K in income for the previous 2 years, or a combined income of $300K if you're married. And it's not all of those, it's one or the other potentially. And I would say that the other thing here is that angels don't have to fill in a form and submit it. It's self-proclaimed. So, but you do need to be accredited to make investments to get onto a cap table of an early stage company. The other thing I'll just mention about angel investors that I think is important to know as a founder looking to raise money from them is that they're typically driven by personal interests and experiences, and they may want to be more hands-on than you might experience with other investors. They really enjoy that process. They wouldn't be doing it if they didn't enjoy the process of getting to know and work with a company and investing alongside with the founder. So something to be thoughtful about, whether that's good or bad, depending on what the angel brings to the table, but just to be cognizant of that. And the other thing I'll mention is that this accredited status, if you are not accredited, there are ways to invest still, and that's through things like crowdfunding and Kickstarter and a couple other things that are out there. So it doesn't mean that if you don't fit into this bucket that you can't invest in early stage companies. So with angels, what they're typically focused on is they've kind of set aside a certain amount of their net worth to invest in this category. And it's typically about 10%. And the other thing that I would mention is that they try as you can see from this diagram here, the probability of returns increases with the larger number of investments that you make. So that when I first started investing a number of years ago, I was told, well, you need to make 20 investments. And then this past year, somebody said, no, you need to make 40 investments. So it's increased over time, but somewhere in that, there's a sweet spot there, I think. But the idea behind that is obviously that 90, as we talked about, 90% of startups are failing. So that means you need a couple to really hit it out of the park, and then a couple to do decently, and a couple to return your money, and that will hopefully give you that kind of return. So some areas to think about in terms of numbers for angels. I'm going to skim over real quick because it's really more focused for people going into the investment world, but just to think about some of the areas that angels are considering when they're looking at putting their portfolio together. And it's not just the size, the number of investments, but it could be what industries they're investing in, how they're going to go about that, whether it's directly or groups or funds, and we'll talk about those later. And the time commitment it takes to do this type of work as well. So now we've kind of talked about an angel where it's an individual. And now I'm going to shift to the venture capital side. And so what is a venture capital firm? It's a form of private equity where a firm has general partners who are making the investment decisions and limited partners who are the investors in the fund. And I think that this chart here really gives a nice graphic representation of what that is. And so you can see that red box is the venture capital firm, and it's usually the general partner is the founder of that firm. And they will launch potentially multiple funds. And so that's that blue box in the middle is the actual fund. And they will solicit funds from investors, which they call limited partners, to put money into that fund. And they put money in typically as well. And then that fund is what the venture capital firm will use to invest in startup companies. So that's where you see on the bottom those investment. So that becomes their portfolio of companies that are part of that fund. And I think that hopefully demystifies a little bit about how that all works. And then there's a lot of text on the slide, so I apologize about that in advance, but there are just a few areas that I wanted to dig into a little bit. While if you're an investor and you're committing to a venture capital firm for this fund that you're going to put a certain amount of money in, you don't have to necessarily provide it all at once, because the firm will deploy that money over a number of years, and between 2 to 4 years, depending on how they've structured it. And so if you commit to 100K, maybe you do 33 every year for 3 years. So just to keep in mind that if you're making a commitment, it's not necessarily that an investor has to provide that funding all at once. And then the fund will typically invest, over those number of years, and that's when they'll call to receive the additional funds. And then the other thing that I will mention is that many firms have a thesis, and that could be an industry, or they want to invest certain geographically, or there's a certain trend that they're seeing, but they have a theory about why their investments are smart ones. And I think it's really important as an investor or a founder to make sure that you're aligned with that thesis. And I would say, I can't tell you the number of times people have reached out to me that are in some area that I've never invested in, or I haven't been involved in any group that's done that type of work. And it's frustrating for everybody because they don't get the answer they want. And I'm frustrated that they haven't looked at the details behind what I actually invest in. So just be cognizant of that, and you'll get a better outcome in the long run if you're aligned as well. Another area I would say that is good to think about is that a lot of VC firms might specialize in a certain stage. And First Row, for example, who I work with, they are exclusively focused on the pre-seed stage. And so with that comes a lot of knowledge about that pre-seed stage and what founders really need. And there's a lot more, I would say, hands-on help and such with a company or a firm that is focused in that space. Some firms will invest in pre-seed, but they also invest in multiple other stages, later stage. And so they might have a more broad spectrum, which is also incredibly helpful. But just to think about, if you're going to raise money, what is that firm, what are they specialized in? How do they focus their energies? What's going to be beneficial to you as a founder? And then the other thing I just want to highlight, because I think it's important as a founder or investor to understand how a VC firm actually makes money. So when you make an investment through the firm, 2% of that typically goes to administrative costs. And then there's a 20%, which is considered their carry. So what that means is that it's the amount of profits the firm retains after they've returned the money that you've invested. Any of the profits beyond that initial investment, they will take 20% as their compensation. And that's a pretty typical model for a VC firm. So they call it the 2 to 20 rule. And so I just wanted to make sure people had an understanding of what that was. Key differences between angels and VCs. We've talked a little bit about it in the descriptions. I would say one thing to think about is, you know, a VC makes investments with the hope that this one investment will return the entire fund. So they have to understand that every company that they're investing in has the potential to be $1 billion company, right? And as an angel, you might be willing to take a bet on a company that has a much smaller return if you feel really confident in them. So I think there's a little bit more flexibility in an angel's perspective in terms of what they might invest in. And then also even in the process with which a company is being reviewed by one of these groups, I would say, you know, VCs typically have a very strict process with which they review companies. And an angel might have a much less strict view. So they might only need certain documents or not need to do as much due diligence on certain things, or maybe they do more. But just to keep in mind that there's different processes that these two groups work with. And then what we talked about a little bit, or what I talked about a little bit before, is that kind of support and the network that they bring with them. So to think about, you know, how are they connected in? Is this angel, you know, are they really well connected with other angels that might join them in an investment, or are they really knowledgeable about marketing? So that could be really helpful to me at this stage. And thinking about VCs, like, well, maybe they know other VCs that they can introduce me to down the road if I'm raising another round. So really trying to understand that there are differences between them in terms of who they know, what support they might provide. I think Minda from First Row Partners mentioned that there's gas versus rocket fuel too. There's a big difference between angels and VCs. And I kind of like that analogy, because the rocket fuel is the VC, they really push you to accelerate, and the angels are kind of the gas that gets you going a little bit. So I thought that was an interesting way to think about it. Whether an angel or a VC, one thing you should always consider is that it is a long-term relationship, hopefully. And so you want to make sure that that person on the other side of the table is someone you want to communicate with for years down the road. So just keep that in mind as you choose who is going to invest in you or who you will invest in. And I know it's easy to want to say yes to every investor, but if you really don't like the investor, you shouldn't say yes, because they will be the thorn in your side as you're getting going. So the typical process, and what I mean is, like, what's the typical investment process? The identification of the investor or the company, I would say, is the first step, obviously. And there are so many different ways to get connected. It's through networks, it's through Twitter, it's through, I mean, there's tons of ways to find companies. Through accelerator programs, I found some amazing companies that I've invested in through accelerator programs. So there are lots of great ways. So just start researching, digging around all over, and you can identify companies. Once you've kind of found that company you're interested in or an investor you're interested in, you reach out vice versa and have that kind of intro conversation. I would say the key thing, and most of you founders probably know this, is to have some sort of a pitch deck that gives a quick overview. And that, I would say, from my perspective, has always pretty helpful. So if somebody reaches out to me and they don't share a pitch deck, my first question back is, hey, can you share a pitch deck? Because it kind of goes through some core key details that I just want to have an understanding, that they have an understanding of, before I have even a conversation. And not everybody's like that, but that is definitely something that I appreciate. And then you'll go on to have that intro conversation, which is typically for me like a 30-minute intro call. You get a feel for the business, for the founder, for the investor, and then you kind of decide whether you want to pursue it further and get to that next stage of kind of due diligence. And then when you reach the due diligence stage, it's when it gets much more in depth. And this is the stage that probably takes a little bit of longer time, depending on who you're working with. You want to talk to other team members, you want to look at some documents, the financials, and really get a feel for the market. And so that requires more work on both sides, probably. And hopefully, a founder, if you've been through this one time, you've got a data room set up where you've got all these docs, and it's pretty easy to continue these conversations with other investors. But for an investor, it's really digging in deep on those, and then potentially talking to people in your networks that might have expertise in the company that you're investing in. So it takes a varied amount of time. And then there's paperwork, which we'll talk about in a second. And then there's the investment. And I would say that this process, it varies depending on who you're working with. So it can take anywhere from 2 days, which is very unusual, to 3 months or more. So if you're working with an angel that already knows you, has basically just so let me see the docs, let me do my checks, make sure you're incorporated in the right place, and then you're done. Whereas if you're working with a program or an event fund or something like that, it could take a longer period of time. And most firms, if you're talking to a VC firm, will tell you what the general time frame that they take to go through the process, so that there's clear and expectations are clear. So this is a big disclaimer. I am not an attorney, and this is some of the work that I least enjoy. But I did want to talk about the things that I've seen the most in my investment work to date. At the early stage, you don't typically see a priced round. You haven't, a priced round means that you need to put a value on your company. And in early stages, it's very hard to do that when you haven't created much value. So to alleviate the need to value your company, there are some common vehicles used to invest at this stage. The first of which I've seen a lot of recently, is the SAFE. Many of you may have seen these. It's super simple, templated, typically founder-friendly vehicle. It's was created by Y Combinator, and if you go to Y Combinator's site, they have these documents accessible. You can download them, review them, check them out. I mean, it's a very straightforward vehicle to use. They are not debt, and I think that's the key between these two things. The convertible note is a short-term debt instrument, but the investor, if you're investing via SAFE, has the right to convert their investment into equity at a later qualifying round. And I would say one thing to consider with the SAFE is that it's typically a faster way to get capital as a founder, because you don't have to wait for everybody to sign a convertible note and invest in the round. So with the SAFE, you have an investor sign it, and then they can wire you the money, and then you're ready to use. So it's a slightly different path to get the capital as well. The other thing that I'll mention here is that in both the SAFE and the convertible note, you'll typically see these terms, the valuation cap and a discount rate. And the valuation cap is not a valuation of the company. I think it's important to understand that. It is really the maximum valuation your investment is going to convert at in that next round. So it might be that you have a $10 million valuation cap, and the next round is at 15 million. That means that you will buy that at a discounted price when your shares convert to equity. And that is really to incentivize and reward those early stage investors that believed in you. Same thing with the discount rate. It's just a different way of structuring that, which is a percentage discount on that round, that higher number. So, and those are typically found in both the convertible note and the SAFE. I would say for the convertible note, which is slightly more investor friendly, because you can add more clauses, and it just takes a little bit more time. It's slightly more complicated. They are short-term debt though, and that's why you'll see here I've listed there are maturity dates, interest rates, and so it acts more like a loan in that sense. But they still, your equity would still convert at a future qualifying round, which would be potentially price round. So similar but slightly different, little longer documents, has more clauses, more negotiation potentially, so it just takes a little bit longer. The other thing I will say is, as you all know, that things have changed over the past 4 years, and 2 years ago, the markets were so hot, people were just throwing safes out there and signing things, and convertible notes, when I first started investing, were more common, and then safes became really common because it was a very quick way to get things going. And now I've seen a few more convertible notes coming around. So as the pace with which these types of deals come together, it seems like there's some shifts in what types of instruments are being used. So now I'm going to dig a little bit deeper into some of these groups, which I hope will be helpful. and some of the reasons why and some of the different specifics about them. I would say for direct investment is very straightforward, which is great. But there are a lot of things that come with that. And I think that one of the biggest considerations when you have an investor that wants to be direct on your cap table is it takes more time for everybody, because you're managing this one relationship as opposed to a relationship one with many. But and as an investor, you're really focused, you're the exclusive person focusing on doing the diligence and understanding the deal and maintaining the relationship. The other thing to consider is that with the direct investment, as a founder, you don't want to have $100,000, $2,000 investments on your cap table, where you're kind of tracking that many investments across that many investors. So founders will typically set a minimum investment amount to do a direct investment. And that can be somewhere, 25K is one that I've seen most common. It can be 50K with some companies. It just depends on where they're at and what round they're in. So just to keep in mind that you do have to invest more as an investor. And as a founder, you don't want to have a ton of direct investments. It just makes things just a lot of paperwork and makes it a little bit more complicated. So to try and think about what that number might be. There's no real additional cost to doing that, doing it this way, except for your time and any professional advice you might need. So just some considerations with having people invest directly. Another option is to work with a syndicate or a SPV, many times called special purpose vehicle. And that is where money of multiple investors is pooled to make a single investment. And again, as I mentioned before, for the founder, having that one name on the cap table is much easier than having 20 names of $2,000 investment. And for an investor, the benefit is really that you can invest smaller amounts. I've seen minimum investments in a syndicate at 5K, sometimes even below that, but average, I would say 5K minimum. And so you really can go in on something that you really believe in, but not have to do that higher number. There are some costs potentially to consider depending on who's managing the syndicate. I've managed a couple syndicates myself for different angel groups, and we haven't done any carry. So that's just keep in mind that's not always going to be the case, that you'll see that I as a manager am going to end up taking a certain percentage of the profits. But it is standard with things like Angel List or the syndicate or some of these other groups that you see here. So those terms vary quite a bit with syndicates. And so just to be thinking about that. Other considerations with that is just, what's the management platform? How are they communicating? Because if you're, an investor, the good news is a founder, you're only communicating with that one person that's managing the syndicate, which is great. But then the person who's managing the syndicate, you need to, as an investor, be sure that they're sharing information, because obviously we want to be kept up to speed about what's happening with the company. So just thinking about what the communication is on behalf of the manager of that syndicate. There are a ton of angel groups out there. And I would recommend looking at the Angel Capital Association website and digging around for a while. Because there are angel groups of all sizes and makes, and it's a very good way to get yourself as a founder in front of a larger group of investors. And as an investor, you have this great benefit of that they're typically managed professionally. They bring deal flow to you, so it takes away a lot of the brunt of that time commitment. So angel groups can be a really great thing. This is my personal biased opinion, probably. Some considerations to think about is obviously what's the thesis of the group, who are the members in the group, do they have expertise beyond maybe will supplement my knowledge? Will that help me as a founder, because they've got a great number of people in their group that might be able to provide good points of connection for me for areas I need help in. And some examples I've listed here, Alliance of Angels typically invest in the Pacific Northwest. E8, who Lily mentioned I work with, has a climate focus. There are groups like Golden Seeds that focus on women entrepreneurs. So, and life science angels, healthcare. So there's, you know, a whole bunch of different groups that have, you can match with what you are most interested in. And I should say that with this, the way you invest, you can either go directly, so that an angel group might present an opportunity to you, and then you will communicate directly with the founder, or they may organize a syndicate and allow investors within the group to invest as one entity for that founder. So a couple different ways. It just depends on the group and how they structure that. There are event funds, which I think is a great way to learn by doing and collaborate and meet people. And from both sides, I think, you know, investors get to understand the process in depth, go through every step of the way. Founders get the experience pitching and meeting investors and building up their data rooms. And the investment amount, again, is slightly lower. The thing about the event funds is, you know, when you're pooling all this money, and then at the end of the event, you typically see 1 to 2 investments that come out of it. And so you're not going to get a broad span for this, but you're putting in 5K, so that makes sense. A little plug, I know the Seattle Angel Conference is coming up, and they're recruiting for their session that should be launching, I think, in February, for both founders and investors. So check that out. They're a local event fund. And then I know Apis Angels is running their program a little bit later in the spring. So if you're interested, I think they have some educational events coming up. It's definitely worth checking that out. Lots of good opportunities to learn through this process. And I think that's the real benefit of these types of funds. And this is another, I'm going to skim through some of these a little bit faster, but this is angel/annual funds. And an example is Sea Change is a local here in Seattle fund. They're professionally directed. They put deals together. They put them in front of a group of angels. You still learn by doing, you collaborate with others, and then you will end up investing in multiple companies. But your investment as a founder is a slightly higher amount. And for a founder, the good news is with this is that you're getting, they typically have a larger check size. So you might have, you know, up to $1 million investment maybe from a fund like this. Just depends on the size of the fund that they've raised. But from an investor perspective, you still get to, you know, really dig in and do some of the work based on what your time capacity is. So they are a great option as well. And they do typically have an investment fee and a carry. And then VC funds is another great option. Sometimes they come post angel funding, sometimes they don't. I'd say the great thing about VC funds is you have these, you know, expert general partners that are really leading the way. It's a low time commitment for an investor. You know, if you're investing in a fund, you're going to get multiple investments to create your portfolio. And for a founder, obviously, there's some great expertise that comes with that. And costs, as I've talked about, the 220 rule. And again, like I mentioned earlier, to think about that some are pre-seed only, some are seed, some do all rounds. There's a lot of great resources that can come with VCs as well. So a great way to invest as an investor, because you get some expert investments being made on your behalf and helping you to build your portfolio. So I throw these last few slides in here just to show you that an early round for a founder can come from many places. So you can have some people who may have invested in you as friends and family come into your next round alongside an angel group, alongside some individual angels and maybe some really early stage VCs. So it can come together in lots of different ways. And, you know, here's another example where one of those angel funds put in a larger check, and then you had a VC leading the round that helped you negotiate set terms, and so they can come together in lots of different ways. And then here I wanted to just show, because, you know, as an investor, as an angel, you know, the idea of trying to put these companies together and all these different ways you can invest there are multiple ways to build that out. And so you can invest through direct and do some SPVs and invest in a VC fund and get to your allocation that you're trying to reach. So lots of ways to put things together amongst all of these different groups. So what's next? Research, plan, and I should have added another thing, that's go do it, which I didn't put there, but I will add for my next presentation. There is a ton of information out there, and I know that UW and CoMotion do a lot of great programming, so please attend their presentations. They've got some great content that they put together. Outside of that, there's tons of resources online. I've listed a number here. Because I work with First Row, I had to include them on the bottom here, but they do a great event called Deals and Drinks, which is both for founders and investors. And it's the coolest thing because you get together, a real founder will pitch, and you get to do the Q&A, and then the founder leaves and everybody in the room gets together and asks questions and tries to dig through details about that particular pitch. And then that information is then provided to the founder after the fact as well. So it's really an educational event. And as a founder, you get to kind of be on the other side of the table and understand what the investors are asking. So that's my call out for Deals and Drinks. They're also doing a fundraising 101, which is a great follow-up to this, coming up in February. So you should check that out as well. Lots of resources online. So do your research and then start planning. Ask the questions that you need to ask to figure out where you need to go next. And I would say that the most important things on these list of questions is really about network. And when I say network, I'm not meaning like build up how many people you know. It's really about talking to people to get a better understanding of things and to get advice, because one conversation leads to the next, and all of a sudden you're talking to the real person you need to talk to because you've connected with one person. And so, or you've gotten the information you need, or you've shared that knowledge that's going to be helpful to somebody else. So I personally think that's what this is a lot about. So important. And I will end with that. And I think I've done okay on timing. So I will go back to you, Yuli, if there are any questions, I'm more than happy to answer them. If people want to connect, feel free to hit me up on LinkedIn. And thank you.
Thanks, Karen. That was great. We definitely have some questions.
Okay.
You mentioned that founders should be thoughtful of the investors they work with. What is the number one thing that founders do not consider when choosing investors? And after that, what is the biggest first-time mistake?
First-time mistake for working with an investor, or? I think it's probably understanding. I mean, I would say that understanding what help they can provide, or being very clear about expectations from the beginning. Because if you're going into a relationship and the investor has told you they're going to do X, Y, Z for you, try and really understand if they really can do that for you. I mean, I think the trick is to talking to people in the community and understanding if this person has a reputation, if they don't have a reputation. You find out very quickly, because it's such a small community, if there's a VC that has done something that's not nice to a founder, you'll find out about it if you ask it around enough. So I would just suggest that you're thoughtful when you're talking to somebody. Go look and see what other investments they've made. Maybe talk to somebody they've invested in and find out what their relationship has been like with that investor, because I think that's telling for you about what that relationship really is gonna be like. Some investors will be nagging you every week trying to get updates and impeding your ability to actually move forward. So I think that those kind of reference checks are pretty critical. And some investors don't talk to you at all, but you need their help, right? So just really trying to dig deeper into what they bring to the table and how they can help you, I think is important.
Do you have any examples of questions founders should ask potential investors?
Yeah, I mean, I think it's about finding out, what are some of the other investments you've made, and how have you liked to engage with those founders, and what do you think? And I think also asking them very critically about your own company, right? Like, hey, so you're interested in me. What are some of the blind spots you think you see that I might need help with? And how do you think you can help me with those, right? And I think that's where, if you don't know anything about go-to-market and you're transparent with an investor about that, that's great. That's okay. Like, you don't have to know everything. We don't expect anybody to have like full knowledge about all aspects of everything. But if you came to me and said, hey, I really need help with this, do you have anybody that could help me? You know, that's a great way to find out if an investor is a good fit for you, because then they can help supplement some of those things when you're just getting going and you don't have the funds to hire a huge team. So so really asking about yourself and saying, hey, what do you think I need? Or I think I need this. How do you think you can help me with that? I think those are good questions for sure.
Great. You know, looking back, what do you wish you knew at the beginning of your career that you know now?
Oh gosh, I don't know. You know, that's tricky because the beginning of my career was very different, right? Like, I mean, I worked in the arts for many years. Like, I mean, nobody has a traditional trajectory in their career. And I always say that one thing led to the next, led to the next, led to the next. And I wouldn't know what I know today without having done what I did in the beginning. So I don't know. I don't have a good answer for that. What would I want to know early on that I would help me today? That's a very good question, but I feel like it's been a slow progress and I'm pretty happy with where I am today, but wouldn't give up what I did before either. So it's all learning.
Yeah.
That's not a good answer for that one, but.
It's an honest answer, right? Like, I used to work with a transportation startup, and now I work with biotech startups. And
yeah,
at the surface level, it seems like nothing in common, but I think I definitely took lessons from those early days and applied it here. Again, very different. And I didn't even come from a scientific background. So overall,
exactly.
Yeah. Like,
exactly.
Sometimes I sit here and think, how did I get here? So, yeah. I think like you covered a lot of great things. So we have a pretty quiet room, but the last thing I'm going to ask this for my colleague, Ashley. What are you currently reading?
Oh, what am I currently reading? What am I currently reading? Gosh, I read a lot of fiction right now because I do enough work in the daytime and wrangling my kids that I need to go off into someone else's land, I would say. But the other one that's come up and I need to reread is Atomic Habits, I would say, because I read it a while ago and now I need to maybe come back to that. But yeah, I've been reading some fiction that trying to think of what the most recent one. I read Mad Honey. You know, there are a couple of different books, but lots of interesting stuff to take me away from my daytime stuff. But I need to get, if others know great books that I should be reading, send them my way.
Yeah, find you on LinkedIn, connect.
Send me some good book recommendations.
Yes.
And that would be fabulous. I'm open to any and all. Yeah.
Good to know. I know you're sharing your contact information. Will your presentation be available to share?
Yes, yeah, I can share it. I'm absolutely happy to do that.
Okay, great. I believe there's one more question in the watch party. I'm trying to see what's going on there.
Okay.
Am I live? Okay. My question is, this is strange.
It must be strange to see me on the video screen.
Well, I'm seeing myself right now, so that's not what I expected. But yeah, when a founder comes to you and they're too early, what is missing that leads you to conclude that they're too early?
It goes back, I would say, to some of that product market fit. I would say in terms of, you know, do they have some concept that they can prove that they've gotten some traction in the sense that they have customers that are willing to pay for what they're trying to offer. So if you came to me and said, I have this great idea, some people will invest in ideas. And so I don't discount that. But for me personally, I want to understand that you've spoken to some real people about, you know, the validity of that particular idea or concept, that you've gone that distance, because in my mind, that means that you are already connecting with your customer, which I think is so critical for success of any company. So, so that would be one thing I would say. I I've absolutely invested in companies pre-revenue. That's not, you know, a must have for me, but just really that kind of real understanding that you know that there's a market for it and that there's people that are going to pay for your thing, widget, whatever it might be.
Thanks. I believe we have one more question in the room, so it's going to pop up.
Okay.
Hi, Karen. It's Erin. Do you work with companies that have done SBIR or TTR grants a lot? I was wondering because the application timeline is so much longer for the grants.
Do I work with companies that have done grant type work? Was that the question? Sorry, you broke up a second there.
Yeah, where the first step is the SBIR National Science Foundation grant.
You know, well, the company that I worked for, the climate company I worked for, did do a lot of grants. And so I have some familiarity with that, but that's not necessarily my specialty for sure. But there is a lot, I mean, the timeline for those types of things is a lot longer. And I know there's a whole different process that goes along with that, but there's a lot of great benefits to working with that type of funding, right? I mean, it's non-dilutive for you as a founder. It allows you to accelerate your research and get to points where you don't need to work with angels or VCs, for example. So I don't know if there's a specific part of the question or any follow-on question to that, but I have done some work in that space.
Give them a second.
Does First Row have an investment thesis? Like, are there any areas that First Row is looking at closely right now to invest in?
Yeah, they are. Yeah. So First Row is focused on basically media, kind of data and human collaboration. So things that it's software companies, typically SaaS, and they, you know, things that basically allow you to do more open opportunities to more people. So if it's some sort of a platform that allows people who might not have been able to do it historically to do it, to be able to access that resource. So they've had some great investments there. I don't know how many investments are in their first fund, but yeah, so data, media, and kind of that human collaboration amongst those spaces. And I do highly recommend, I know I'll do another plug, but to go to Deals and Drinks, because it'll be great. And I think for many of you that are on at UW, you probably have run into Minda or Yoko before. They both teach on campus in a variety of entrepreneurship classes. So, so hopefully you'll run into them as well. And they're the founding partners of First Row.
Great, thanks, Karen. I think that's all we have for today. I did get a book recommendation for you tomorrow and tomorrow.
Oh, good.
So apparently.
Thank you. Well,
yeah. Yeah.
Okay, great. I'll add it to my list.
Thank you so much. We really appreciate you sharing your time and your knowledge with the whole group today.
Thank you so much for having me.
Yeah, of course. Please come back anytime. Thank you all for joining.
I might join you for the Jens Molbach one next week.
Yeah, come by next week. Thank you all for joining us today in person or online. A big thank you to Karen again for sharing her wisdom and experience with the group. As a reminder, next Friday at noon, we'll be hearing from Jens Molbach, who will present Building Stronger Business Models Through Tri-Sector Innovation. Sign up for that, and we'll see you next week. And we'll see you next week, Karen.
Great, sounds good. Thank you, everyone.